Good evening, ma'am. This is Anuj Sangvi, enrollment number 20 BSP 0333, Section B, IBS Mumbai. This is my report on COVID-19 impact on banks in India. Sorry for the delay of my submission as I stated the reason before. I would start with the introduction. The worldwide COVID-19 pandemic has risen a dark swan occasion which will require unprecedented measures from government over the globe to help continue financial security in light of the pandemic, which is probably going to be under control. A few monetary situations demonstrate worldwide downturn of differentiate sizes. The circumstance has hit the Indian economy when development has eased back to the most minimal in 10 years. In the ongoing past, there were indications of green shoots of recuperations in the Indian economy. Nonetheless, the looming flare-up of the infection is probably going to seriously affect the recuperation cycle. The administration and the controllers have reacted by furnishing a monetary upgrade bundle with a few measures to support liquidity and give patience on money related and consistent duties. Monetary establishments have taken responsive measures to the pandemic and plan to diminish face-to-face communication, scale back tasks while offering budgetary help to retail and institutional clients. As the pandemic of the COVID-19 has risen undramatically, many business organizations and the world and the states, along with the national governments in their respective countries, have probably made contingency plan to contain the following virus, saving the financial structure of the economy of every country. Uh, the administration and the controllers have reacted by furnishing a monetary upgrade bundle, which is probably by making business models, crafting new business models for this crisis. After we evaluate the effect, the pandemic is affecting the money related administration at part in numerous manners, from business continuity issues and operational compensation to general monetary viewpoint. As money-related administrations, organizations are activating and finding a way to limit these effects. Amid the highly uncertain situation due to the pandemic, financial institutions need to stress their portfolios for each of the defined scenarios. To better understand the impact, the current economic and market environment warrants additional stress testing would also have a direct implication for decisions these financial institutions will make in time. A continued spread of the pandemic and its aftermath will significantly slow down businesses. Hence, financial institutions must take additional measures to ensure business continuity to continue the remaining relevant T plan that best equips the bank for crisis. There's a high need for the organizations, especially the financial organizations, to have a business remodel their organizations, their products, their services, their way to reach to the consumers and their service takers in such a manner that the current crisis and the pandemic doesn't affect the financial organization of the world in that manner which it has already done. Moving on, flattening the curve with rapid responses. This is what the financial institution perspective should be. Flattening the curve implies showing resilience by minimizing disruptions and ensuring the financial impact of the pandemic is mitigated over a long period by making or crafting business remodels, by making new policies, by ensuring customer support during this crisis. Beyond the operational actions already underway, financial service industries players need to actively consider the short, medium, and long-term operational, financial risks, and regulatory compliance implications resulting from the continuing uncertainty around the pandemic. It is very important for the business organizations to make contingency plan for their respective organizations to not take a hit from this crisis. Banks and financial institutions must reanalyze their business models and plan for different scenarios. Budgetary institutions need to anticipate various situational activities are standardized, keeping both their clients just as representatives needs at the focal point of their organization. It is normal that the administration will intend to address the more extensive financial difficulties which has been faced by the organizations and their employees. There will be interruptions and wrongdoings. Anyway, these difficulties will open up decisions for extending client connections, interest in innovations of things to come, move in mentalities to genuinely receive and execute eventual fate of work. If we look at the Indian banking sector, before touching the real issue of this article, let me give you a background of the Indian banking sector along with the non banking financial companies. A bank is an institution which has a primary function to accept deposits and lend money to needful individuals, which is its probably a basic function. Businesses and governments. Banks are considered to be trustworthy around the world, where any individual deposits money in the bank. Doesn't matter what it is, the amount, the individual knows that the money will be safe and sound. Besides this, bank provides numerous services such as loan facilities, fixed deposit scheme, debit and credit card facilities, and other financial services, as we all know. The Indian banking industry, which is nearly 200 years old, has been expanding and modernizing since the initiation of reforms in 1991. Now, this industry has evolved into a current size of Indian rupees 81 trillion, 8.1 trillion, I'm very sorry. A study by KPMG in 2017 made a prediction that the Indian banking sector is heading towards becoming the fifth largest banking sector in the world in the year 2020 and the third largest by 2025. India's non-banking financial companies have assumed critical importance in the financial system. NBFCs in India can boast of having total size of asset of more than $370 billion. Dollars. A lending book of NBFC has grown at around 18% annually over the last 5 years. The NBFCs are serving the underserved and often ignored retail and MSMEs segments, which are the backbone of India's growth. For instance, credit to SMEs or MSMEs grew at that rate. As we get on a closer look for the impact on banks, the Reserve Bank of India, which is probably the central bank of India, has taken certain measures to give some relief to the lending institutions in areas of liquidity, regulation, and supervision, and financial markets. The following are some of the business and accounting considerations. First of all, starting with credit risk assessment, the RBI has given waivers to the borrowers which incorporate ban to pay head and enthusiasm with the unwinding or their arrangement as a non-performing source or a resource, or on the other hand, a rebuilt resource. This has been actualized to assist borrowers with holding over transitory monetary challenges. In any case, banks could recognize and screen the borrowers who are confronting transitory and long haul monetary challenges. Such borrowers will be provisioned likewise because of this crisis of the pandemic. Banks would therefore be required to maintain robust risk management functions to get in cope with the NPAs and the other non-performing clients who hasn't been paying the loan after taking a bunch of loans, and track their borrowers individually to determine and segregate the permanent impact from the temporary impact and make an appropriate provision. We have mentioned below some of the key areas that merit consideration. Liquidity. Given the situation of the lockdown in the country, the defaults may have increased substantially as many companies would have lost revenue for a long time. An increase in defaults is likely to have caused issues in liquidity and capital adequacy. However, the central bank has come up with certain measures to provide liquidity to all lending institutions. These include auctions of target long-term repos of operations of up to 3 years tenor of appropriate sizes at floating rate, linked to policy repo rate to be deployed in investment-grade corporate bonds, commercial papers, and non-convertible debentures over and above the outstanding level of their investments in these bonds as on March 27 March 2020. Second being reduction of CRR of all banks by 100 basis points to 3% of the net demand and the time liabilities which will affect the reporting fortnight beginning 28 March 2020. Moving on, as the concern and the impact of the subsequent events of this crisis on this aftermath is being viewed by many officials and government officials and the governments, we give the criticism of likely the effect of the episode of this crisis of the virus. There might be material vulnerabilities that cast huge uncertainty on the element's capacity to work under the ongoing current and concern premise. On and off the chance, the element readies the fiscal summaries under the going concern presumption. It will be needed to reveal these material vulnerabilities in the fiscal summaries to explain that the supposition that is subject to such material vulnerability, not all the elements will be influenced in a similar way. And in a similar way, critical judgment and ceaseless update to the appraisal till the date of insurance or the issuance of the budget reports might be required. Given the developing nature of the flare-up and the vulnerabilities in a question. Further, the BFSI segment in India should guarantee that successful cycles are set up to distinguish and unveil material occasions, for example, insolvencies of the borrowers or effect of loaning portfolio because of the liquidity of the business. As we look into the impact made on the NBFCs by this crisis, there's a need for a business remodel assessment by these NBFCs to cope up with this crisis. Due to the significant change in the market conditions, firms may have to revisit their business model assessment for their existing financial instruments. In the case, the scale of loans or investments is due to an increase in credit of the increased rates, then it would be consistent with the business model objective hold to collect as a credit quality of the financial assets is relevant to the entire ability to collect contractual cash flows, and the scale is triggered due to the significant deterioration in the market condition or the counterpart specific credit risk problems. However, the entity may have to assess the business model of such financial assets, institutions, instruments which it plans to sell. Basically, what it means is that the NBFCs with other financial organization has to business or reassess their current services of products or their way of making relationships with their customers in a new way after this COVID-19 pandemic. Complexity in the determining the impact of expected credit loss. There may be a large scale business disruptions that can potentially give rise to the liquidity issues for the certain entities. This might also have constituent impacts on the credit quality along with the supply chain. Due to this crisis, there has been disruption in the supply chain not only for one country but for the whole world. There has been a blockage in the supply chain where which has relatively caused a less demand, more supply. Likewise, this also has led for many countries to import more of the products which they have been exporting before this crisis. Entities should carefully assess the extent to which the high degree of uncertainty of any sudden changes in the short-term economic outlook are expected to affect the life of the financial instruments. A greater emphasis may be attributed to a long-term stable outlook, as evidenced by the past experiences and to relief measures granted by the regulation authorities. As if we can look into a closer depth of this report of this article or this topic, out of which we can come to a point that the war with this COVID-19 crisis might drive technological advancement. Many countries have already been placed in lockdowns, which has probably significantly increased their technological advancement to cope up for the business organization to cope up with this crisis. Even after the tragic losses that a war usually brings, a war always drives technological advancement in 10 years. Time we will look at the pandemic as a trigger that enabled us to spend our time more efficiently and to focus more on activities that really matter. The advancements in the digital technology are making the crisis more bearable and are enabling businesses to keep working with the access to key services, which is communications, payments, credit, collaborations, and everything. At the same time, consumer adoption will increase given the lack of options at the moment, and this will enhance familiarity. COVID 19 could stay with us for months, even years, and it's unlikely to be the only pandemic in the future for the other to rise above. A research methodology which has been made on this article, as expressed beforehand, the current paper is meant to survey the effect of COVID 19 of the current lockdowns on India's banking era or area. To accomplish this target, a few concentrates have been drawn for the current writing accessible on the different institutions or destinations of web as features of meetings of prestigious business analysts, financial administrators, monetary and money-related counselors. The applicable data accessible is different structures and at different sources was checked and seen cautiously while making a correct determination for this article. And there's no verifiable information with respect to the effect of COVID-19 on different segments of the economy, including banks, and just the instinctive appraisals are accessible. These measured information is accessible just about the quality of positive cases, number of cases recouped by the virtue of non-accessibility of quantitative information. The utilization of measurable device was unrealistic. Henceforth, a clear article has been set up with the assistance of online perspectives on the specialist in regards of the effect of progress of this pandemic. Major findings is in this article is that based on systematic review of the online literature regarding the impact of COVID-19 pandemic mainly on the business sector, the rating agency, which is Fitch, said that the coronavirus impact will bring more worries to Indian banks than less. They said the Indian banking system is undercapitalized and continues to saddle with bad loans. There have been many bad loans by many NPAs, which has been still being in that position of a very large ticket size, mainly from many business tycoons which has went rogue. From a banking perspective, travel, which forms 2.2% of all loans and small businesses lending, that accounts for 5.4%, which will be hardest hit, along with sectors such as auto, that depends on all inputs from China. Indian banking was anyways facing a big crisis of mounting of bad debts, due to which RBI had to come forward with a bailout package for private sector banks, named Yes Banking sector in India was in a verge of seeing signs of stability. When COVID-19 forced the Reserve Bank of India to further loosen liquidity, the bad loan rules, the head of the financial institutions at Fitch Ratings, which is Saswata Guha, stated that there has been an expectation of a sharp slowdown in credit growth and deterioration of the asset quality across all the private banks in India because of the shutdown of economic activities due to pandemic since 4 months, which has been no economic activities being going on at that time. The individual impact will depend upon the relative exposure to vulnerable small business and risky unsecured retail segment. Moving on. India's banking stocks have encountered a sizable value erosion since the beginning of the pandemic of novel corona. Nifty, the benchmark index of Nifty of India's bank has fallen alarmingly since the beginning of March. Uh, Kotak Mahindra's bank owner loan growth dropped to 6.7% in the first quarter of the current year 2020. The slowest in and the at least 3 years, down to from 10.3% in the previous 3 months. HDFC has lowest bad debts ratio among its peers. But Aditya Puri, the managing director of the HDFC Bank, stated that they also become more stringent about taking on the new lending. A report of S&P Global Rankings also said that banks in India are likely to witness a spike in the non-performing assets ratio by 1.9% and credit ratios by 130 basis point in 2020, following the economic slowdown on account of COVID-19 crisis. If we closely look to lockdown, probably in countries like India, it is more lamentable both for human government assistance and economics. It's on ground that India neither there is assistance for little undertakings nor joblessness benefits for the individuals. He further also said that including nations, for example India, with youthful socio-economy such as lockdown causes more human enduring than COVID-19 itself. As we also see that there has also been a migrant crisis which has been for 2 or 3 months or more than that and is probably still going on in some or the other way. This is one of the example of how lockdown can impose imposition of a lockdown can cause many problems and challenges to the less privileged sector of the India. Lockdown will have a falling impact on the close to home livelihoods and the person's capacity on reimbursing individual credits. RBI bans on credit has given transitory help, however, it should be perceived how quick the recuperation occurs and reimbursement limit. Miniature and small enterprises advances represented 12% of all the non-food credit, and the area is recorded as one of the most defenseless in this lockdown period. The stoppage in the industry of the monetary action will have to most be defenseless in the lockdown period. The stoppage in the monetary action, the ban on the advances reported by the RBI will empower banks to defer NPA acknowledgement. Be that it may also in a long run, NPAs are relied upon to be spike in the following couple of quarters. That means there will be more NPAs than there were before. If we come to a conclusions, and there's also been suggestions being made on this article, the review of the expert opinions presented in the above mention of the section reveals that the following crisis about the impact of lockdown in banks and NBFCs in India. RBI has given all banks a 3 month grace period during which some relief from rules governing bad loan recognition, but from September onward, non-performing assets are likely to surge if the crisis is still acute. If assets quality starts to deteriorate, the bad loan ratios of the coronavirus crisis has led some banks struggling to hang on deposits as funds might migrate to perceived state-owned lenders. Besides the smaller private lenders, more prominent names among banks such as IndusInd, RBL Bank, and Yes Bank. Liquidity conditions of smaller private banks could force them to reduce banking on account of which companies relying on bank for lending might face weak financials and poor liquidity, which has probably been a sole and very occasional issue in the Indian banking sector. It is also well known by the bankers that this imposition of lockdown by the government of India on March 25th, 2020 by Prime Minister Modi, the RBI has taken numerous requisite steps to ensure normal business functioning by the entire business sector even during the lockdown period. Further, fresh measures, the RBI infused around $6.5 billion of additional cash for banks and NBFCs to lend to shadow lenders and small borrowers. Moreover, RBI has relaxed the timelines of bad loan rules and barred lenders from paying dividends for the year ended March 31st. Even after withdrawal of the lockdown, the banking sector will take a long time to revert back to normalcy, to its normal state, based on the above findings and assessment of the financial sector situation. The following measures are recommended. The central bank must take all possible initiatives to maintain sufficient liquidity in the financial system and its constituents in the face of COVID 19. Adequate bank credit flows in must for putting the small and medium term enterprises on the track afresh after the lockdown is over. Government is required to take decisions and actions to lessen uncertainty and financial stress in the economy. Continuously measures should be taken to enable the smooth functioning of both money and capital markets in a sync of both of them working along. All enterprises must put in place business continuity plans to operate for disaster recovery so that there is no disruption in customer services, which is probably the main part which the financial organizations has to look into for the customer service to resume in a much greater way than it did before. And by that, I mean going digitalizing every customer transactions or making them know about this thing, which to whomever they doesn't know, is one of the way that the banks can cope up with this crisis. Government, along with that, must take timely initiatives to open the economy to avoid the worst to come. It is very important for the economy to get back in track that it was before, because India as a country is probably economically strong, but not that strong that it can withstand such a crisis if it's been closed on for such a long time. So this was probably my report on this current situation of COVID-19 impacts on banks and NBFCs. And yeah.